For the last several weeks, global markets have been largely fixated on the daily fluctuations of energy prices. Investors were effectively holding their breath, waiting for the energy sector's next move before committing to major financial decisions. Within a 48-hour window, that focus shifted. Energy prices were no longer the primary driver of market sentiment. This wasn't a passive change. A more powerful institutional force stepped in and took control of the narrative. That force came from the world's central banks. Through a series of coordinated announcements, they moved to the center of the market's attention. These institutions are now citing energy prices as the specific reason for a significant change in their outlook on inflation. By linking oil to long-term economic stability, central banks are now setting a new course for global interest rates. The central bank's core argument is that high energy prices have introduced a systemic upside risk for inflation, meaning the risk that prices will rise faster and stay higher than previously expected. As a result, the market's expectation for interest rate cuts is vanishing. In several regions, the conversation has moved past holding rates steady and toward the increasing prospect of further rate hikes. This shift directly impacts the cost of borrowing for everyone, as central banks prioritize fighting inflation over stimulating growth. We can see this play out in the Fed funds futures. Fed funds futures are financial contracts that represent the market's opinion on where the daily official federal funds rate will be at the time of the contract's expiry. As of this morning, those futures are pricing in a 10% chance of a rate hike at the next Federal Reserve meeting. While 10% may seem low, this represents a significant overnight change in how the market views domestic economic policy. European markets are seeing a similar trend, with policymakers there also citing energy costs as a reason to keep interest rates elevated. In the United Kingdom, the pressure to raise rates is even more pronounced, as the central bank grapples with a deteriorating inflation outlook. This global coordinated pivot represents an institutional blockade intended to halt rising prices. Traditionally, bond markets and oil prices move in a predictable, related tandem. However, this week, bonds began breaking away from oil. Bond markets are now completely ignoring the daily fluctuations of energy and are instead repricing based on the central bank's rate outlook. For investors, this means that energy prices are no longer a reliable signal for how the bond market will behave. This rapid shift in policy is reminiscent of the major central bank pivots seen in 2020 and 2021. There is growing concern in the market regarding the lasting inflation momentum of this current episode. Analysts suggest that even if geopolitical tensions end today, the upward pressure on prices may have already become a persistent feature of the economy. The true challenge for wealth preservation is no longer the price of oil itself, but the aggressive and sustained policy response from the world's central banks.